There are so many things that people can take advantage of that aren't necessarily, don't necessarily take extra cash flow to take advantage of that can give you tax savings, but we need to implement them before the end of the year. One of the bigger ones is going to be retirement contributions, because those are some of the things that do need to take place under most circumstances, do need to take place before the end of the year. So for instance, if you're the only employee, if you're the only employee in your business, maybe it's you and your spouse are the only employees in your business, and you have a solo 401k, and you can contribute up to $77,000 each to your 401k that year, and you're in the 37% tax bracket, that's going to give you a substantial savings. Assuming both spouses can contribute $80,000 each, $160,000, and you're in the 37% tax bracket, that's almost $60,000 of savings. And how much better is it to be able to write yourself a check for $160,000, but it really only cost you $100,000? And that's what it's like when you're making those retirement contributions to take advantage of those tax savings. A lot of retirement accounts can be opened up after year end, or at least some of them can. But it is simpler, everything except for an IRA, SEP IRA, an IRA, it is simpler. The first year, there are some exceptions where you might be able to open it up later. But after the first year, you're gonna need to, after the first year, it's simpler and just better to mainstream it once a month or once a quarter, make contributions just on a more regular basis. Because taxes are on a cash basis. If you know that you're gonna be purchasing an expensive piece of equipment in January, for instance, or even just in the first quarter, right? If you wait until the new year, if you wait until January, you don't get those tax savings until you file your tax return next year, right? A year from now. So if it's only the difference of a month, it makes sense that you would pay for it and make sure that you do whatever it takes to place it in service, that's the tax term, place that machinery in service in December so that you get the tax savings basically immediately instead of having to wait an entire year to get those tax savings. And same thing can be done with accepting large vendor payments. It doesn't always make sense. Normally you want to get money as soon as possible, but if you have a good relationship with a vendor that owes you money, maybe you ask them to delay that. Hey, that $50,000 check that you're gonna give me, can you write that to me in January instead of December 31st? But on the same token, they might be thinking the same thing. They want to write you that check to get the tax deduction, so maybe there's a little give and take there. I mean, one of my favorites is gonna be retirement contributions or paying your own kids. Those are some of my favorite things because that's what keeps money inside of your bank accounts or your family's bank accounts, right? And gets you those tax deductions. Probably hunting for those deductions with things that they didn't need to buy. Like an expensive new truck that they didn't really need, but their CPA told them it would get them a big deduction. That doesn't make sense. Now again, it all goes back to if you were going to do it anyways. If you were going to buy that brand new truck anyways in January, then sure, doing it in December makes sense and is a legitimate strategy. But probably the most common mistake is just trying to spend your money on something that you weren't going to spend it on to get a tax deduction. That doesn't make sense. The best time to have a year-end planning meeting is when you have an accurate idea of what your year-end is going to look like. So for some landscaping companies, they might have a really accurate idea of how much money they made by September. And so in October, we can meet and say, I basically know exactly what your tax liability is going to be, and here are the things that you can do before December 31st to limit what that tax liability is, if it makes sense in their situation. But some people, like real estate agents, it can be very difficult to do year-end tax planning because their income is so volatile. You know, they have a couple of houses that are in the queue to be sold, and if they sell before December 31st, then all of a sudden that's taxable income to them. But if it gets pushed till January 1st, then it's taxable income on next year's. They're generally pretty large checks, and so it can make a really big swing, and it's not something that they have complete control over. So it really varies for everyone based on their industry, based on their specific circumstances. But as soon as you have an accurate idea, as accurate as can be, that's the time to do it. And that could be as early as June.